Hey everybody. Welcome to today's webinar. Today's going to be Introduction to Nadex Knockouts and Call Spreads. I know we are starting just a couple minutes late, so apologies for that. But we'll jump right into it to make up for any time. So today we will be going over our Nadex basics of the knockouts and the call spread contracts. I got kind of two title screens there. It's a nice little looking title screen. So before we jump into the thick of it, we have this nice disclaimer. This disclaimer is on every single webinar we do. I'm going to let you read it here for just a second. Very basically what it's saying is trading on Nadex, just like trading anywhere, involves risk. Don't trade with money that you don't have to lose. You definitely want to be trading with money that is discretionary income, not money that you need for your rent, your food, that sort of thing. Also, I will be placing a couple trades on the demo environment today just to show you how the knockouts, how the call spreads work, as well as going through a hypothetical trade in the presentation itself. None of these are recommendations for what to trade. I'm just really going to be picking things sort of at random, and honestly, probably some of the numbers that you're going to see in the presentation are up to date with the current market conditions. So the end all be all is none of it's a recommendation to actually buy or sell anything. It's just purely informational on how this all works. So I think we've looked at the screen for quite enough time here today. We'll go over to the next one. Oh, now you have probably two pictures of me on your screen. Just about me, real quick. I've been working on Nadex since 2017, so focused on heavily the Nadex products and the platforms for the last 3 years or so. And I've been trading for about 12 years, ever since I turned the ripe old age of 18, so I guess that dates me a little bit. Focusing mostly on equity and equity options. Obviously, I would love to trade Nadex products. However, I can't trade Nadex products because I work at Nadex, and no Nadex employees will trade Nadex products. So they're never trading against a Nadex employee on the exchange or anything like that. All right, so let's get off the screen with my beautiful, beautiful face, or at least one screen with it. We have our nice agenda slide here today. And just before I do go into the agenda, if you do have any questions, any comments, any concerns, just want to ask me anything, want me to go over anything, if the stream's lagging out, or you want me to explain something else because I haven't explained it very well, just put it in the chat. I have the chat and the questions up on my other screen here, so I can see them and I'll answer them as they come up, or I'll give some time for questions at the end if you would like to ask them then. So for the agenda, we're going to go over what knockouts are, we're going to go over how they work, all the risks, the reward, the capital requirements. We're also going to go over what call spreads are, and then we're going to, at the very end, jump on to the actual platform itself for a little practical demonstration. We're going to get into a trade, see how it sort of works on both the call spreads and the knockouts. I will be probably peppering in some call spread info in the knockout section, but we'll get right into it for the actual information here. All right, here we go. What are knockouts? So very basically, a knockout is a contract that trades within a set price range, right? It's going to have a floor and it's going to have a ceiling price. There we go. It's two price levels, the floor price and the ceiling price. So very basically, you're going to have a top price that's going to be the ceiling, a bottom price that's going to be the floor. The knockout's always going to trade between these 2 points. You're never going to have the price level going outside of these 2 points. It's very similar to a call spread, where the call spread contract is also made up of a price floor, price ceiling at the top and a price floor at the bottom. However, with the call spread, you can go outside of those ranges, and we will explain that a little bit further in the call spread section, but just wanted to give you a little bit of comparison, contrast between these two contracts right from the beginning. Between the floor and the ceiling of the contract, the value of the contract is going to move pretty much in line with the underlying market. So you are going to have that indicative price, and the buy and the sell sides of the market are generally going to move fairly closely in line with that underlying market, and that is unique to the call spread contract, or sorry, unique to the knockout contract. The call spread contract sometimes does move a little bit outside of that underlying market, and again, we will go into that a little bit later in the presentation. But for right now, the basics are the knockout. You got a ceiling, you got the floor, and it's going to move in between these 2 points. It's not going to go above the ceiling, not going to go below the floor. And obviously, just like any other market, if you think the underlying market is going to move up, you go ahead and buy. And if you think it's going to move down, you can go ahead and sell that contract. So just like any other Nadex contracts, you can take both a long or a short position, a upward or downward direction in these markets and contracts. So how do these actually work? So they can expire in one of two ways. So they can expire either by time. Nope, now, oh yeah, I thought it was going to be time first. So they can either expire by time or they can expire by touching either the ceiling or the floor of the contract. So this touching the ceiling or the floor is going to be what we call a price triggered settlement. And then expiring by time is going to be a time triggered settlement. So basically when you get into a knockout contract, you're going to be in between these 2 points, and we will go more just kind of a numerical example. So to give a little bit more context here for this, but basically you're going to be in between these 2 points, the floor and the ceiling range. It's going to move up and down, just like any other market. If it hits the floor, hits the ceiling. I keep pointing upwards for the floor. If it hits the ceiling, it's going to expire at that point that it hits the ceiling. The indicative price hits it, or hits the floor, it will also expire. If it goes throughout the entire duration of the contract, goes up, goes down, but doesn't actually hit either of those points, it will expire at a set end point and time of that contract at the end, and that is going to be generally for our contracts on Friday afternoon. So we'll go here. I think yeah. So each knockout is going to have that max duration of a week. So they're going to start on a Monday and they're going to end on a Friday afternoon. All the contracts end a little bit differently depending on when the underlying markets end. So for example, something like your commodities generally from like 2 to 3. It's more like actually 1:30 to 2:30, and then a lot of your FX and indices end closer to 3 o'clock. These are all central time, so it'll be actually 4 o'clock Friday afternoon, Eastern time, obviously. At the beginning of the week, for every single market, there are 4 knockout contracts listed. There are 4 knockout contracts listed, and there will always be 4 knockout contracts listed. And that is because once one knocks out, another one is automatically listed either above or below. So if a contract knocks out to the upside, that will expire, and immediately another knockout will be listed above. So you always have those 4 knockouts to actually choose from to go ahead and trade. And that is sort of an automated thing that every time it knocks out, another one is listed there. Then there we go. In almost all conditions, there will be 4 knockouts to choose from. So here we're going and getting into an example here. Give me 1 second because my dog likes to go crazy. He's sitting here next to me. He's trying to dig at the floor. Stop that, bud. One of the joys of working from home is you get to work with your pets right in the room with you, right? So let's jump right into an example here. So we have our gold example, and I think this is supposed to be a little bit of a market going here at the bottom left corner of the presentation there. So you can see your little market going. There we go. Gold opening level. Let's say it's 1820. So at the beginning of the week, level's 1820. And so right at the beginning of the week when these are listed, there are going to be 4 contracts listed right around that level. So the first one going to be basically the market minus 10 points is going to be the ceiling. The floor is going to be the market minus 10 points. So you can see right here, the floor is right here, and the ceiling is going to be plus 40 points. And so this is generally how all of the contracts are going to be listed. And you'll see, I can click through here. So second one, minus 20, plus 30. So you can see they all have this range of 50 points. So it'll just be listed kind of around the market. The third one, the fourth one, all the similar sort of listing styles around that first initial entry point. So you're always going to have one, more in the money, sort of closer to around the actual contract, as well as to a little bit further away. So one is always going to be a little bit, the market's going to be close to the floor of one contract, and then kind of knock out 4 over there. It's always going to be a little bit closer to the ceiling, which is going to actually give you the ability to, if you want to go in an upwards or downwards direction, getting closer to the floor or closer to the ceiling if you would like to, and that's going to obviously cut down on the cost of the capital you need to enter the contract, but the risk there is that it goes against you and does knock you out. We'll get into that a little bit more as we go forward, but this is the general setup of these knockout contracts. And you can see there, yeah, there's a nice little line going across for where gold would be actually trading. and 1820, and then we have our time. I guess this is the time expiration here at the end. So they sort of are banded on three sides, right? So you have your top band, which is going to be the ceiling price, your bottom band, which is going to be the floor price, and your sort of right hand band, which is going to be the time price. So it will expire eventually if it actually hits the time and doesn't hit the floor, the ceiling, or the floor. Why do I keep saying this is the floor? This is obviously ceiling up here. All right, so this is sort of an example of what happens in the relisting idea when a market is actually knocked out. So we still have our four four knockouts here, and let's say the market's moving up, right? And it knocks out and it hits this fourth knockout, right? So it's going to hit the top of knockout number 4. So anyone that was in that contract, let's say I got into that contract at 1820, it's going up, going up, going up. Hopefully I bought the contract because then I'll be making a profit on the trade. It's going to go up, it hits the ceiling of knockout number 4. That's going to be knocked out. That contract is gone, and the any contracts that you would be in as a trader will be settled at that point. Now that you see disappears, turns red, I guess. And then we have the new knockout listed at the price above where the last one would be listed at. So it's sort of going to list again at the 10 points. So it's going to be 10 points below the actual price of the underlying market and 40 points above for the ceiling. And so then you have them listed again. And same thing if it goes down, knockout 1's going to knock out, and there we go, new knockout's going to be listed below. So that's the functionality of listing, how they knock out, how they relist. So you can go ahead and you can trade them. Let's say you think it's going to go in a downward direction. After it knocks out, you can always be watching the market trying to get into a new contract. But it does have that definite end at the bottom, sort of like a automatic stop loss or an automatic take profit at the bottom or the top of the contract for the floor or the ceiling, respectively. And so for the time settlement, basically it's just going to go to the end of the contract. Now, when it does knock out, when these contracts knock out, what your payouts are actually going to be, they're going to be sort of the absolute payouts, right? So if it goes all the way up to the top of the contract and you were the buyer, you're going to get the maximum payout, so that your profit and loss is still going to be how much you paid to get in, or what your payout is minus how much you paid to get in. Similar thing with the loss. But it will be sort of, if it's a 50-point range in gold, and gold is a $500 contract, it's 10 pips a point, or to $10 a point that it moves. You would get the entire $500 payout if it goes and knocks out of the top and you did buy that contract. Similar at the bottom, you would get a $0 payout, right? So the payouts are going to be sort of absolute if it hits the bottom or the top. Now, if it expires by time, it's actually not going to be that absolute top or bottom payout. It's going to expire where the underlying market is. So let's say gold goes from 1820 to 1840, and it doesn't trigger the contract I'm in. Well, I got it at 1820. Let's say I got it on the buy side. I'm going to get that 20 points of movement, and if it actually expires at that 1840 point, I'm going to have a $200 profit there, right? 1840 minus 1820, $10 a point. So that's going to be where that profit and loss is actually determined. It's going to be determined by the difference between where it was bought and where the final settlement value of the contract actually was. So here we have kind of an example of how that might work, how that final settlement time might work. So, we can see here, there it is, it's knocking out at the end of the time there. Let me go actually back to this little example. So, we still have this opening level of 1820. Let's say I got in actually at, I don't know, maybe I got in here. Let's say gold at this point was actually trading at 1850, and this knockout is 1860 to 1810, right? And I got it on the sell side. What I pay to get in, and actually, you know what? I think I have actually. I won't go into what you pay to get in, what you pay to get out right now, because I actually have a better slide on that later on that explains it a little bit better. So I will explain that a little bit better. But just basically, at the end, at the expiration point, your payout is going to be where it expired compared to where the floor or the ceiling of the contract is, right? So it's not going to be that absolute payout at the top or the bottom of the contract. So it is sort of a built-in trading plan. So this is going to be the risk reward proposition of these contracts. You will, just like every other Nadex contract, actually know the maximum risk and potential reward before you actually get into the trade itself. On a knockout, and same thing with the binary, same thing with the call spread, you can never lose more than what you actually pay to get into a contract. So if I need $150 to get into a contract, and let's say it goes heavily against me, all I can lose is $150. There's no marginal requirements, right? There's no chance that, let's say if I was trading a traditional futures contract, I get into a contract that goes heavily against my positions, that I might actually have to pay more than what I took to get in, right? That I might get a margin call, say, hey, you know, whatever company calling me up saying you need to deposit more money into this to actually keep trading this contract. That won't happen here at Nadex. That is your maximum risk. With that maximum risk, though, does come a maximum potential reward. So you will know, let's say going back to a $500 total knockout, if you pay $100 to get in, well, that's going to be your risk, and your reward is going to be $400, right? So, you know, it's the potential upside, the potential downside is capped, and you know that when you enter the contract itself. There we go. The floor of ceiling ranges, they provide those natural profit targets and that defined risk control. So it does work sort of as a natural set take profit at the top and a natural stop kind of at the bottom of the contract. There we go. Profit target and a stop loss level. I should probably click through these as I talk, but you know, I sort of just end up talking for a while. We also have the risk of the reward. So on the risk side, the buyer's maximum risk is going to be the difference between the buy price and the floor. So if I was a buyer, and let's go back to let's do the gold example again. Let's say I'm in a knockout that is 1800 to 1850 in a gold contract. Now that 50-point knockout, that's going to be a $500. So just remember that every one point we're talking about is $10. So if I get it at 1820 and the floor is 1800, well, my maximum risk is going to be 20 points or $200. If I was a seller, same contract, 1820, the ceiling's up here is 1850. That's going to be a 30-point difference. My maximum risk and what I'm going to pay to get into that contract will be $300, right? So you always know the risk and the reward. It's always just going to be the difference between where the market currently is and whatever price you're paying, and either the floor if you're the buyer or the ceiling if you were the seller. Similar thing on the reward side, just like I was sort of just explaining, the potential reward is going to be the inverse of that, right? So if I pay $200 to get into a contract and it's the 20 points, well, my potential reward is all the way running up on the other side, right? My potential reward as a buyer would be if the contract goes from 1820 to 1850, knocks me out on the ceiling, I would have paid $200 to get in. My potential profit would be $300 because I would get a $500 total payout. Similarly, with the same example, I pay $300 to get in as a seller on that same contract because I paid this for risk. The potential reward would be the 1820 minus the 1800, that 20 points or $200. And we will have a little example here to show it a little bit better. So for the let's say I get into the knockout one, and let's go previous. So I get into the knockout one. The knockout one would be 1810 to 1860 if we were sitting at the 1820, right? So let's say it's at 1820. My knockout right now is 1810 to 1860. So this is where it is, 1810 to 1860. We have our floor at 1810 and our ceiling at 1860, right? So very simple. We also have our expiration time over here at the end of the contract. And I bought at 1820. That's going to give me a total cost of capital, cost again, and a total risk of 10 points. And if it's 10 points, $10 per point, that's $100, right? So if I bought at 1820, this is my total risk as a buyer. My total potential reward as a buyer is this entire green section as we go up. So if I bought in at 1820, my risk is that 10 points or $100. And if it goes all the way up to 1860, my potential reward is that 40 points or that $400 of potential reward, right? So if it goes down to here, I will lose my initial cost of to get in, lose that initial $100 buy-in, and if it goes up to the top, I would get my total $500 payout, and my profit would be 500 minus the 100 I paid to get in for a $400 profit. Similar side, we'll go through a very similar thing here with the sell, but it's just going to be the inverse of what we just looked at, right? So we're actually going to go with the knockout number 4. So it's actually going to be a very, very similar example here, because in the first example, we were getting into as a buyer, the knockout that is closest to the floor, or the knockout where the price is closest to the floor. Here's a seller, we might be wanting to get into the knockout where the price is closest to the ceiling. What's going to result in that situation is you will pay the least possible amount for the contract with the highest potential reward. However, you do have to remember the movement needed to actually knock you out on the other side and get you out of the contract is a lot less in that scenario. So that's sort of the balance of the risk of reward in this. So again, we're going to look at the knockout number 4. So here we have the 1830 to 1880. Or sorry, this should say 1930 ceiling, right? Oh, okay, sorry. This is correct. It's just sort of the upside down example. So we have the ceiling at 1830 and the floor down below. So if I actually pay this to get in, so I'm gonna, if the floor is at, sorry, this should say 1780. That's where this is a little bit screwed up. So I will have to change that for the next one. So I will get in. I have my ceiling at 1830. I sell at 1820. That's going to be a 10-point difference, so I'm going to pay $100 to get out of the contract. And then the downside there, I'm going to have to pay the total potential reward is going to be, if it goes all the way to the floor, I'm going to get that $400 worth of profit, or the 40-point move on the downward direction. So the capital requirements necessary for this, you do know the maximum risk before the trade is actually placed, and the capital requirement is always going to be that maximum risk, as we did chat about a little bit ever. There are not going to be any margin calls, just like we did, again, chat about earlier in the webinar, so you never have to worry about that. And buying and selling the same in terms of knowing your maximum risk, your maximum potential reward beforehand. What is interesting with this, and yeah, so minimize capital requirements. What is actually interesting, so let me go back here, is with these contracts, you get something that's known as sort of effective leverage. And effective leverage might be a little bit more of an advanced concept, but I do want to discuss it with you, because what's happening here, and actually I can even, well, we'll do it with the sell side. So I'm actually getting one-to-one exposure to the underlying market, but I'm getting it at a price of only $100. If you were to do this on, let's say, a futures exchange, or even for something like an index with buying the underlying, ETF or whatever, futures, but if you just wanted one-to-one with sort of a similar ETF that you wanted to buy, trying to get exposure to the entire index, where you're going to end up paying to get that one-to-one movement is way, way, way higher than what you are going to end up paying to get the one-to-one movement here. It's obviously going to be different per market, per marginal requirements, depending on where you're trading, but there is no way that you're going to be able to get one-to-one movement, or at least not many places that you're going to be able to get one-to-one movement for a price of $100, and without a potential over leveraging yourself, right? Without potentially having the downside risk there be extremely high, because you've taken on a lot of leverage. If it goes against you, you might end up having to pay a lot more than what you actually paid to get in. Here, because it does have that set defined top and a set defined bottom, you do get this sort of very cheap cost to get a one-to-one movement with this market, without that potential downside risk of losing your shirt and losing a lot more than you wanted to, if it did potentially go against you. So if you do want to read more about that, I think we have some articles on our website. I know this is just a sort of more of a primer, but that is, I think, one of the most attractive things about both the knockouts and the call spreads is being able to get that movement with the underlying market without having to either pay a massive amount or have to take on a massive amount of risk. So we'll go by this capital requirement. So we are going to move on to the call spreads. So the call spreads are very similar to the knockouts in some ways and pretty different in other ways. It is still that predefined range, so same as the knockout. The range is between two price levels, same as the knockout. You have the floor and you have the ceiling. Where it differs, though, is it's not going to move one-to-one always with the underlying markets, and that is because of how the contract is made up. The main difference here between the knockouts and the call spreads is if the knockouts hit that high floor level or the low ceiling level, I said that backwards every time, the high ceiling level or the low floor level, if it hits those 2 points, the contract's not going to end. It's not going to actually expire. With the call spread, you can actually have the market go above or go below your floor or ceiling level. The only thing that makes that contract expire is by hitting that end time, by hitting the time expiration. So it is going to move similar to the underlying market, but because it's not going to knock out, you do have this this concept of time value. You have this concept that's more baked in of time value, where it's not going to move one-to-one with that underlying market. You have this optionality, and optionality is we're not going to go fully into what it means because again, this is a basic primer, but it is because it only expires at expiration. There we go, the no price triggered settlement. And I know I went through this on the last one. The volatility and the time to expiration will impact the price. So you do have that premium. You have that optionality premium that isn't there in the knockout because you don't have that knocking out aspect. You don't have the automatic stop or automatic profit at the top and bottom. And I will show you this, and when we go into the platform here in just 1 second. What time? Okay, we're doing pretty good on time. So we'll do about 15 minutes of the platform after this, and I'll show you sort of how the knockouts are moving one-to-one and how the call spreads sometimes are similar, sometimes don't move one-to-one. So yeah, this is actually a very important thing. With knockouts, with call spreads, and actually with the binary options as well, just because there's not an expiration, just because the contract is not expiring, doesn't expire, especially with the call spreads, won't expire at the top and the bottom, doesn't mean that you actually have to wait until expiration to get out of these contracts. With all Nadex products, you can exit the contracts early to either limit your loss or take profit, depending on if the market is up or down from where you entered. There we go. So you can choose to exit the position early for a profit or a loss. So if I get into a contract, let's use the gold example again. If I get into let's say the 1800 to 1850 knockout, and I'm at 1820, if that market moves up to 1840, well, it's not knocked out yet, and it's before the end of the week, but I can actually go ahead, sell my contract back into the market, and take my 20 points or $200 worth of profit before the contract actually expires. So it is a nice thing, and it's a nice thing to remember for not only the knockouts, not only the call spreads, but the binaries as well. You can exit them early, take your profit off the table, or limit your losses. If you're down a lot, you can always limit your loss and you don't have to take the entire losses if it hits the bottom or hits the top of the contract, or for the binaries if it expires above or below the strike. So let's jump on into the platform here pretty quickly and go through what these look like inside the Nadex platform. So I'm going to log into my demo account here, my nice demo. My demo's called I Like Nadex because I like Nadex. I'm going to take a drink of my water because I am parched from talking for so long. All right, so you'll see when you get into the platform here in the demo and the live environment, they both look very similar. You can choose your call spreads, your binaries, your call spreads, and your knockouts at the top left-hand corner of the screen. So I'm clicking around here. I have my binaries, my call spreads, my knockouts. We'll start with knockouts and we'll go over to call spreads because I think it's a little bit easier to do that way. So we have been talking about gold this whole time. We can do gold. We can maybe do oil too. I think oil is always one that is somewhat easy to understand. So let's jump over to oil and let's see what's going on here. just because I think the numbers are nice and round sometimes and a lot easier to sort of understand for these contracts. So I'm going to actually move out so we can see all of these. Let's on the chart itself. I'm gonna hide this real quick. Okay, so we have our knockout range, and you can see on the contract itself, you can see the range of the knockout right here. So you see the top of this knockout is 84, the bottom is 79. Now, with the crude oil, it's always important to remember what sort of the value per tick, the tick value of the contract is. So for crude, these are only 5 points wide, but they are still $500 contracts. So for every point in this, or every full point, but every tick is going to be basically $1. As you can see, as I move it up or down here, but every tick is kind of $1. Every full point, if oil goes from 80 to 81, that's going to be $100 point, because every 0.01 is basically $1 in the crude oil market. We can also see here you have a visual representation of the knockout itself. So let me kind of drag this over, and you have a visual representation of all 4 knockouts on the left-hand side of the screen. So it's a little bit hard to see because I do like using dark mode, but you can see them here. I have my 4 different levels for my knockouts, and I can select them as we go up and down, and you can see, this is the 85 to 80, which I am going to use as our example here because it's nice round numbers, right? Nice and easy to go through when you have nice and round numbers. And you have, so for your first knockout, 80 to 85, down to your last knockout, 82 to 87. All of them are going to be 5 points wide. All of them are going to be 5 points wide, or $500 total dollars. Now that's not going to be every single knockout is not going to be $500. It is important you look at the ranges, but for a lot of them, they are. Can you set a take? We have a question coming in. Can you set a take profit order ahead of time? Yes, you can, and I will show you how to do that here in just 1 second. So let's go ahead and let's just get into a contract here. You can also see as I select these up and down, you can either select your knockout, from the chart itself or from the side panel here as I did earlier. And to get that side panel back up, you can hit the markets tab here. Any questions on the platform too, feel free to ask them. I did help design the platform, this new platform, so do know a good bit about it. But to get after you've selected them on the chart itself, to get the deal ticket to come back up, you can see your buy and sell prices on the top. So we're gonna go ahead, we're gonna buy this contract. We can do a market order, and you'll see here. So first of all, you have the indicative price at the top left, 80.648. That's what the contract is trading at right now. So you can see as it moves on the chart, it's going to move at the top left with the indicative price. You have the time till expiration, so it can expire right at the top and the bottom, but it can also expire via time. This expires at 2:30 p.m. Eastern time tomorrow, and so that's going to be 1 day and 1 hour from right now, or about, right? You also have this crude oil contract. December is going to be the futures month for it, 80 to 85, so that's going to be your range, 80 to 85. Expires at 2:32 p.m. tomorrow, and then you have your buy and your sell price. And you will notice that these aren't right on the underlying market, but they are going to be right around that underlying market, right? They're going to move right in tandem, where the midpoint is generally going to be right at the underlying market, or right around that underlying market, right? So they're moving in tandem, and so we can go into the buy side. I'm going to do a market order here. If I do a market order, actually, so this is a pretty easy thing to see here. So if I do a market order at 80.5, my max loss, if 80 is touched, is going to be $50, right? So if I were to get in at 80.5, every 0.01 is $1. That's 0.50 is $50. So I'm going to pay $50 to get in. If this does go down here, that's going to be my max loss is $50. My total potential profit is going to be $450, and that would be if this runs all the way up here and hits this top, hits the top of 85. And so you can do 85 minus 80.5. That's going to be 4.5 or 450 ticks, 450 examples of 0.01, right? So let's get into this right now. And actually, it's going to be a little bit different because the market has changed since I've been talking, as markets tend to do. So we're going to get into this contract. I'll place my order, and we can see I did get into this contract here. Now, what I actually paid to get in was 80.64. So my actual max loss on this would be $64, right? 64 points from the bottom of 80, and my max profit would be what is it? 430? No, not 434. 434, yeah, $434. That's if it goes up to 80, 85, right? We could see also I'm currently at a $2 loss. That would be if I got out of the contract right now, because like every contract, if I get in on the buy side, I can exit it on the sell side. Similarly, if I get in on the sell side, I can exit by getting out on the buy side price. So always important to remember there. Now, the question I had just a second ago, can you set a take profit order ahead of time? Yes, you absolutely can. And there's a couple ways to do that. The first one is one of our newest features that we've put in. Actually, this is only in the demo environment right now, but it should be in the live environment either tomorrow morning or Monday morning. We're very close to releasing it, is what I'm going to say. So this is actually a new, it's functionality that's always existed, but it's sort of a new skin for that functionality. So let's go ahead and see what happens here. If I hit the set take profit target, it's going to bring up a new order ticket for me that is sort of smart. It knows where I can actually set it. So if I got it at 8.64, I can move this up and I can see, okay, let's say if this goes up to $83, I want to get out. Well, we can see if it does go up to $83, my profit target would be $236 above the current point. So, and you can see here, if I got it at 80.64, 80.64 plus 2.36, that's going to give you 83. 2.36 times 100, $236. So again, it's this is why I like using the nice 80 to 85. Makes the numbers nice and easy to kind of work with. So if I hit this place limit order, I can place it, and it is going to. So I just placed my limit order, and you can see that actually that exists over here in my orders tab. So my positions tab is going to show the positions I am currently in right now. My orders tab is going to show my working orders, my orders that are out there kind of in the ether, that are out there waiting to be hit if it does go up. So if this were to run up to a price of $83, this would actually exit my contract at that point. I'm going to get out for a price of $236. Right? I still, if I didn't have this, the top of my contract would still be 85. The bottom will still be 80. If it does run down to 80, it will still expire at that point. One important also thing to remember is that you cannot currently set a different stop loss on the contract. So you have these built-in stops. The functionality for stop losses we don't have quite yet. We do want to get there at some point, but you can put on this automated set profits ahead of time. So that's one way to put on the set profit. Those of you who have traded here a little bit longer and might actually remember, you can also just enter a similar trade on the other side. So if I just go, if I do set this to 83, that's actually going to be the same exact thing that I just did on using the set profit target functionality. So if I just do this, and we actually go over here, you'll see that just changed to 2, and you'll see these contracts are actually the exact same. So there's a couple of different ways you can do that. Now, the set profit target, definitely the easier way to do it, and it's sort of just reskinned functionality, like I said, because you have been able to do this, but I think it makes it a lot clearer. And again, that will be in the live environment either tomorrow or Monday. I would need to check the actual release schedule, but it's very close. We have been testing this in our demo environment for quite a few weeks now. So that's going to be getting out of the contract. Now I can just get out of this position right now. Let's say I just want to take this $2 profit. Now remember that profit and loss figure right there that you see on the bottom right here. This doesn't take into account fees, and a fee will be $1 to get in, $1 to get out. So if I were to get out of this as a $2 profit, I'd actually just be breaking even. But I can always go ahead and hit this close button. And this is actually sort of another skinned functionality. It is going to get me out of the contract at the current market price. And so I can go ahead, I can close this out, and it's going to close out my contract. And remember, if you do have set profit targets out there, remember to close these out as well. If you do, if you close out of your contract and you don't want these to still exist, you can go ahead, click on these in your order panel, right? and just delete your order. Click delete. Now I have no orders, I have no positions. I'm completely out of the contract. Same thing if you're on the sell side as well. I mean, I'll show you very quickly. So if I'm on the sell side, it's just the inverse, like we talked about during the presentation. If the price is 80.6, my max profit is going to be $60. My max loss will be 440, right? Because what I'm paying to get into this contract is this entire range. So that'd be a $440 cost to get in for only a $60 profit. But again, I do have a lot of room for it to run against me. Let's say, because what you're risking on the buy side here is, let's say I get in, it goes down, it hits that 80, and then immediately pops back up. Well, I'm going to be knocked out of the contract, and I'm not going to, I'd have to get back into another one where if I get in further away, right, I can actually, this market can run against me for a while and then still come back in my favor, and I'm not going to get knocked out of the contract. So that is really the basics of knockouts, with showing how you get in, how you get out, how you place set profit targets beforehand. And again, I'll just do really quickly. If we go to the sell side here, you can also get into contracts. So we see, we have this bottom knockout here, the knockout number 4. I can actually get into this one now. And sometimes if I'm getting in the buy side, I try to get into ones closer to the floor level, so I don't have to pay as much. If I'm getting into the sell side, I try to get into ones closer to the ceiling, so I don't have to pay as much. Remember, there is that risk though, that it does go up and very quickly knock you out. But so you can see here, this is closer to the actual ceiling price of 82, and it's further away from the 77. So if I get into a sell side contract here, I'd only be paying $135, right? So 80.65, 82 minus 80.65, it's 135. And if it goes all the way down, I have a max profit of $365. All right, let's look at the call spreads really quick, because I do want to make sure we touch on this maybe a little bit more interesting aspect of them. So let's go over to one of the indices for one of the call spreads. You will notice for the call spreads, a lot of these are just sort of daily call spreads. So we can go to US 500 is pretty popular. So you'll see here, I can choose all my call spreads here. I have my different expiration times. If I click on it, it will bring up the actual call spread overlay in the middle and the deal ticket on the right-hand side. The deal ticket's going to look very similar to the knockout deal ticket, right? Just because the actual makeup of the contract is pretty similar. It has a floor, it has a ceiling. The difference really is that floor and ceiling range doesn't actually knock you out. So you will see here, if you look on the left-hand side, I'll go back to our knockouts very quickly here. So if I look at the left-hand side for the knockouts, we can see that the buy and the sell is the same for all 4 knockouts, and they're all trading right around that indicative price, right around what the underlying market's doing. Well, if I go over to the call spreads, go back to the US 500, well, now I'm seeing these 5 knockouts, they're all priced a little bit differently, right? Some of these are priced 86, 76, 67, 63, 57, 44. They, on the buy side and the sell side, similarly, they're all sort of around each other, but they're not priced the same, and they're not necessarily right around what the underlying market's doing. So why is that? Why are these priced so weirdly, where the knockouts are sort of priced right around 1-to-1? And that's going to be because of the optionality aspect of the call spreads. It's going to be because that time value is more important, more baked in, and it's also going to be because you can actually go above or below the price, you can go above the ceiling or below the floor, and you're not going to get knocked out. So you have that extra added in, sometimes benefits, sometimes not, but you have that extra functionality of, let's say I get into here, I'll just show you an example here. So let's do one that's, okay, so we can kind of zoom in here, and you will see with the knockouts as well, you do have these ranges here. So you can see the ranges overlaid on the contract itself. So let's say I want to buy this call spread contract, right? So this call spread, it's 466 to 469. That's going to be a $300 total contract, right? So that's the, it's the 30 points in the US 500 is going to be worth $300 because every 0.1 every 0.1 movement in this is worth $1. So that's 300.1 movements or $300 contract, right? That's you got to make sure you know the tick value of the contracts you're trading for the call spreads and knockouts. But if I get in here and let's say I want to buy this, so first of all, the market's trading about 46.63, and if I want to get in, I got to pay 46.69. So not too far off what the market is actually trading right now. I'll do a market order. We can see our max loss, max profit, just like the other example. And I'm already at a little bit more profit and loss because it's not trading right around that market. But what will happen here is if, let's say, because obviously I want this to go up, I'm on the buy side. If it goes up, I am generally making money, just like on most contracts for the buy side. And if it goes down, I'm generally losing money. Now, if I were in a knockout and this went all the way down here to this point of 46.60, I would get knocked out and I would immediately realize that loss of how much did I pay to actually get in this? I would immediately realize that loss of about $30. Oh no, $10, $100. Sorry about that. So I immediately realized that loss about $100. So I paid $46.67 to get in. If it goes to $46.60, I'd immediately say, okay, that's a loss of $100, and I'm knocked out. Now for the call spread though, I wouldn't be knocked out of that. For the call spread, it can go all the way down here, and I can still be in the contract. So what you're actually doing is you're sort of you have that premium built in because you're sort of paying for that time value. You're paying for the opportunity for it to move back in your favor. Because if it goes all the way down here in a call spread, I'm not knocked out. I'm only expired when it actually expires in 3 hours. So I'm actually buying some time for it. Let's say it can go all the way back here and then move all the way back up in my favor. It's possible that it could go all the way down, move all the way back up, and I could end up profiting. While if this were a knockout with the same exact makeup, I would be knocked out of the contract as soon as it hits the bottom. I wouldn't have that time to go ahead and have it come back in my favor. So that's one of the benefits. Obviously, conversely, maybe it goes all the way up. I don't have that set built-in take profit. Now I can put a take profit on to actually lock my profits in. So I actually can put that take profit on to get out early. But if it goes all the way up and I don't have that take profit set, well, it can go against me. There's no built-in take profit like the knockouts have. So that's sort of why you're paying a little bit more, or why these prices aren't necessarily one-to-one, because you are paying premium for that time value, for that optionality, for that time to be correct. And that is why it's not sort of one-to-one on the market itself. So it's a little bit maybe more of an advanced concept, I'd say, but I think it's fundamental to how the call spreads work and what the differences are between the call spreads and the knockout product. And it really is what differentiates why you might want to trade either one. We can go down here and we can, so this is, so far below. So I'm going to have to pay a lot more to get into this contract. I'm paying about 20 points off of where the contract actually is, because, I mean, if it expires right now, like I'm already expiring sort of at the floor ceiling. That's the other point of this. If, like, let's say, because these obviously only expire by time. Let me hide this so we can get a better view of this. So let's say I paid, I paid $100 to get into this contract, right? And it goes all the way up here and it keeps running up. Let's say it goes all the way to, it doesn't stop at 46, what is it, 46.69. It keeps going to 46.70, 46.72, 46.75. Well, my profits are actually still going to be capped at this 46.69 point, even if the market's all the way up here. So at expiration, even if the market's all the way up on the very top, I'm still going to expire by what I paid to get in versus the ceiling, right? That's still going to be my payout. So I'm still only going to make $200 on the contract out of $100 what I paid to get in. I mean, that's still pretty damn good. Like that's still a return of investment of about 100%, right? Paying 100 to get in, getting $200 out. So that's still a pretty good ROI. However, it's not, it is going to cap you on the bottom. Same with the loss. If it goes all the way down here, and let's say the contract expires, when the contract expires, the underlying market's all the way down here, well, I still can't lose more than this $100 I paid to get in. I still am going to expire based on where I got in versus the floor of the contract, not necessarily where the underlying market is at the end. Now, if the underlying market expires somewhere in this range, then yes, I am going to be paid out on that. So let's say I got it at 46.67. Now it's at 46.68 when it expires. Yeah, that is in between these two ranges. I'm going to get $100 profit on that because my payouts can be 46.68 minus 46.67. That's sorry, 46.60. 46.80 minus 46.70. I keep saying that. I'm sorry, but it's going to be that 10 points, so it's going to be that $100 payout. So it is going to be based on where you get into where you get out. So I hope that was helpful. That's really all I have. I can't show you the set profit target. Very similar to what we had before, right? So I could say, if it goes up 20 bucks, I can place that. And again, it's showing my current contract and my order on the actual contract itself. So you can also set the set profit targets on the call spreads as well. So that's really going to be everything I have for today's webinar. I am going to throw up my last slide here. If you do have any other questions, feel free to throw them in the chat right now. I know we are going on about 55 minutes, so thank you so much, everyone, for coming, hanging out for the last hour. I really hope this was helpful. I hope you learned a little bit about. I hope you learned a little bit about call spreads, about knockouts, about how. Well, can I just go to the last slide here? I hope you learned a lot of stuff here. I'm going to stop doing this because this is just ridiculous. We're just going to put this up. So if you do have any questions after this, you can always email us at customerservice@nadex.com, or you can go ahead and live chat us. The live chats can be found on the website. Both of those are going to be the easiest way to actually get in contact with us, get any questions answered, excuse me, outside of any webinars or anything, but you can always throw questions up here. If you are liking Nadex, go ahead, throw us a Trustpilot review. Our marketing team always likes me to tell you to do that, but it does really help us. It does really help us out to leave us a good review, and follow us on socials. We have all the goodies, all the gradies, all the socials. So go follow us on there. I do recommend following us on Twitter at least, because we do tweet out, when there are wild things happening in the market, new products, new contracts, new trading hours, that sort of thing. We put those in the platform and on the website as well, but some people do sit on Twitter for longer. And also YouTube. This webinar, the recording at least, will be up on YouTube shortly after this ends. So if you do want to rewatch it, you do want to revisit anything I said, you do just want to look at my beautiful face for a little bit longer, go ahead, go to YouTube, watch this webinar or any of the other ones that are given by any of the other great presenters that we have here at Nadex. I don't see any other questions coming in, so I am going to go ahead and wrap up the webinar here. Thank you so much for joining me for this last hour. I hope it was helpful, and good luck for the rest of your trading, and have a great rest of your day, everyone.